All right, today's video is going to be about the potholes you need to avoid when investing in multifamily real estate. So this is the stuff that I needed this stuff. You guys have heard me say it hundreds of times in all of my videos. Like there's certain things that I wish somebody would have taught me as I got involved in my real estate investing career. And if this helps you guys, great. But sometimes I need to constantly remind myself because no matter how big of the deals that you start investing into, whether you're passive or active, you're always going to go back and be like, man, I could have did better. So number one for me, it was size. Boom. Bigger is always better in real estate. The number of units is the most important number in real estate investing when you're doing stuff. Scale, that should be your point. If it's one door, don't do it. So just trust me. And like 40 doors is better than four. 400 units is better than 40 units. Size is always going to be your number one thing. So if you can avoid that pothole, just go bigger right out of the gate. Next, it's going to be cash flow. It's got a cash flow. Boom. If you know the deal's going to cash flow, then you can weather any economic storm. Long as you're making money, you're not going to sell it. You're investing money in a deal that cash flows. You don't care what's happening in the rest of the market. And that's a pothole. Like a lot of people want to. I had a broker ask me the other day, are you willing to eat a negative cash flow for a couple of years? And I was like, no, not at all. I want to cash flow the day we close. If we close in January, February, March, or January, February, whatever, we need to get a check, right? Like the next month, January and then February, we want to pay, we want cash flow. So that was a pothole I missed. And sometimes I'm like, maybe we can need a negative cash flow. If you're doing small deals and you think you're going to sell fast, great, but not when you're investing money. Number three, price. So I price shopped. I tried to go after deals that I could get after, or I could think with, or the money that I had, or the investors that I had, rather than just like, hey, what is the best deal, right? And when I'm talking about price, I'm talking about purchase price. There's price per door. There's like all these different ways you can come up with the what price really is when you're investing in real estate. But in multifamily real estate, what I'm talking about today is I'm like, hey, look, if we're looking at a deal for $80 million versus $8 million versus 800,000, like that matters. So don't price shop. That's a pothole that you can just avoid once and for all. Just look at the best deal that you're going to invest your money into. All right. Next, I won't number these, but we'll go P&Ls or profit and loss. These are the statements, financials that you're going to get. Like a lot of people don't know how to read financials. You may look at it and be like, hey, what's real, especially the seller's financials. Not that they're all going to lie, but that tells the story of the property, right? If you look at I can tell a mom and pop or some type of family that runs it, that has their own people, their own bookkeeping, things like that, as opposed to looking at an actual group that's partnered with an institutional investor and go, okay, their financials are a lot different. When you're looking at those things, you got to understand profit and loss. What are the financials? Whether it's T12, T3, whether they're just going to give you like 1 month and you're going to have to annualize the next quarter, like all those things matter. When you're doing these things, those are potholes you should avoid as you're investing money in this stuff. So next one, we have deferred maintenance. Deferred maintenance, right? Deferred maintenance on a deal. That's a problem when you're looking at deferred maintenance on a deal. Like how much did they not take care of the property? How much were we going to have to put into it when we go into it? A lot of people look for those deals. They're called value add, but technically this is problems that the last seller didn't take care of that you may need to be taken care of. And on the way in, everybody's like, "Ooh, cool! Look at all the stuff we could do to this place." But that was a problem. When I looking back, that's a pothole you can 100% avoid. Just go after good stuff right away that you don't have to worry about coming in and fixing something or trying to make people happy because you solved the problem, being the new person, right? So next, this is the pro forma. We'll just go there. That's the pro forma. That is what the broker gives you that says, hey, we found this deal. This is the pro forma of what we think it can do. I want to look at their stuff. I need to look at their stuff. But my job, just like for you, is to avoid the pothole of only taking the pro forma as face value. You're going to need more information. And that goes right back to when you're looking at a P&L. What do you think this is going to do? If this is good and they're telling you it's going to be way better, do you think that you're ever even going to hit this? And this is important to know because that's a pothole. Some people don't really know what they're doing. That's why I tell people and why we created Bell Capital. Because look, if you're already looking like, dude, the right size. And I don't have time to go do all this stuff. It's got a cash flow. Vic's finding all that stuff with his team. Price not a concern for them because we're investing as a group. He's already done the financials, read them. They already know what the deferred maintenance, if there's any at all, and he's not basing like all these things you got to know if you're going to be investing money as an investment, right? To things to avoid. These are potholes. All right. Let's see. Another one is location. You hear me talk good about location, but there's a lot of, if you don't know what a good location is, you aren't going to get a good location. You may think a good location is a bad location, right? That's what I thought too. I was like, oh, because I kept hearing, oh, you know what? If you're going to invest in the worst property in the best neighborhood. That's dumb. Get the best property at the best location you can get your hands around. That is a good deal. Doesn't matter the price because you're buying the location. Like that was if I could have avoided that pothole alone, it would have saved, I probably would have made millions of dollars. I haven't wrote it out and figured out how much money I've actually lost on buying the wrong location, even though it was the right property. Like that's if I can save you time on that one, location and cash flow is the number one potholes to avoid. Always invest for cash flow and always invest in the right location. All right, the next one would be management. Uh, who's going to manage it? The management company. You heard me talk about it before. The management company that manages a C class property with a lot of Section 8 and low income tenants and things like residents. That's not the person you're going to get to manage a plus location, A plus location, or triple A location in an A class property. It's a different management company altogether. The hardcore Section 8 management companies that are basically police officers that say no, no, pay your rent, or we're going to kick you out. Like that's a different class of different group of people, not class, but different group. Their mindset is different. So not the avoid one of the other potholes to avoid is the wrong management company. That's a G. Having either the wrong management or no management. Like that right there, I could save you a bunch of headaches. I've went through so many management companies with my multifamily properties over the years that we end up building our own team at the time when we were self-managing a portfolio that we have for some investors with us. And that was probably that's how we learned what needed to be done. And now we can just manage other companies, bigger management companies to those points, right? So next, debt. Get the right debt. Other vital piece. Right now, the debt market is crazy, right? But every deal that you look at needs to be bankable at some point. It needs to be able to carry debt. Some lender across the planet needs to want to give you money on there, not just to hamstring you, but to actually become your partner. Your debt people are your partners. And the pothole to avoid is bad debt. There's a lot of properties out there right now that have bad debt on them. And if they're trying to get out, the easiest way to get rid of a bad property is to sell or finance it. So some of you guys out there that want to get involved in doing the deals on your own, not people who want to invest in Bell Capital, but you guys are looking for people with bad debt so you can try to take it over in hopes that you can take a noose off of their neck, put it on yours, and you can hang longer. Promise you, man, that's not going to happen. So when you're thinking through debt, what is the debt right now? Is it interest only? Is it principal and interest? Did you underwrite the debt? What's the debt service coverage ratio, the DSCR that the lenders are looking for? Is it a big enough? Because the bigger the deal, the different debt market that you're going to go to. Is it Fannie Mae? Is it Freddie Mac? Is it a life insurance company? Is it a debt fund? What are they? What is the marker that they're using? Are they using a 10-year treasury, which most do, or are they using a LIBOR? Right. So like there's so much you got to know, which is why I said that's why we created Bell Capital, because some people are like, dude, I don't want to know. I don't want to learn. I just want to invest money and I just want to get cash flow checks. Like that's why we did all this, because there's so much to know, right? Let's see, what's another one? We got did I do bad debt? Let's go bad debt. Bad debt. This is important too because people don't get this. This right here is a cash flow killer. You may get into a deal. Let's say you invest money in a deal, but you didn't look and see, hey, look, their accounts receivable. How are they getting them? Are there a bunch of evictions going on and they're chasing down money? Is there a bunch of money sitting around that's being owed that they can't collect 30, 60, 90 days? Is there no reserves sitting around? But we see that there's deferred maintenance and they don't have any money sitting and they can't collect any money because everywhere around them, the liabilities of all the properties around them in that market, the tenants, the residents that are in the market are causing this huge debt problem, bad debt problem associated with the financials, the P&L on the asset. Because remember, you're buying a business here. You're investing in a business. So if you don't know all this stuff, man, this right here can sink any ship. Let's see. And one of the other ones, and I know I've been through this a lot, is like lost deals. Lost deals. I've been working deals. Maybe we had a deal under contract or LOI on a deal, and we'd be like, hey, look, you know what? We found something we didn't like, and we walk away from that deal. One, that costs money. Two, it costs time. Three, you need to have enough deals in your pipeline. These are pitfalls, right? Potholes to avoid in the road. Like if you don't have, let's say we're working a deal, one deal we were doing, we were working on that deal for like I think we were in the deal for like 45 days or so. It was a mid-sized deal. 45 days in, we found a bunch of stuff and the seller didn't want to do anything about it, so we pulled away from that deal. That deal was lost, but I still needed to close the deal. Right. So the problem with that was it was a lost deal. So unfortunately, I needed more properties in my pipeline for us to continue to underwrite and look at. I shouldn't have had the one deal locked in. I should have had two or three deals locked in, knowing that we were going to probably pull the trigger on one or two deals and then stagger them out. That's another pothole you can avoid. But this is important because when you take a look at, hey, is it the right size? Do you even know what the right size investment to make? And right size deal, if you're going to do this yourself, what size deal should you be in? It should be 16, 32 units minimum. My best deals were in that range, 22 total. I had two properties right down the way from each other, and we ran them as one asset. But those are small. When we exited those deals, we made 700,000 on one, 900,000 on the other, above above our down payment because we had already recapitalized all our investors out, and then that was profit. But because that size of deal, you got to be like, hey, I got to make $1 million on a deal, period, or I will not do it. That's 16 units, 32 units in a high price market, California, Hawaii. Then maybe you can kind of shrink it down a little bit to 10 units, 12 units, 17 units, something like that. But that's the right size if you're doing it yourself, right? If you're doing it with a group of people, for us, we're looking at 100 units, 220 units, 300 unit deals. Like I'd rather invest in the 300 unit deal because we'll make that 300 unit deal will be worth more than a 30 unit deal in 10 years, period. And if you have a small percentage of a 300 unit deal, you're going to make more money than you would have owning 100% of a 30 unit deal. Anyways, I love that part, man, because I try to share that with people. People don't get it. You don't have to own 100% of everything. I'd rather own a little piece of something big than 100% of something small. So cash flow, don't do it if it doesn't get a cash flow. If it's one unit and you're the cash flow component, if they move out, you got to pay it. Like, don't think it won't happen because it will. Even if they move out, you lost 1 month rent, 2 months rent, it kills your cash flow. It does, right? Not only that, while it's happening, you got to think about it. You're like, I hope they're doing what they need to do. Even if you have a management company and a management company is too small, or the deal is too small for a single family house, they're going to take 10% of the collected rent. So, anyways, the price. That's don't price shop. The deal is the most important thing, right? Next, you got to know the P&Ls. You got to understand profit and loss. The seller's profit and loss. Is it a mom and pop? Can it be understood? Are the numbers wrong? Is the expenses way off? Right? Because there's rules of thumb. If you haven't got my book, get my book, How to Create Wealth Through Apartment Building, Investing in Apartments. Like, hit me up. It's in the link here. But there's rules of thumb. We call them ROTs, rules of thumb that show you exactly how certain numbers should be if they're operating correctly. When you kind of have an understanding of that, now they change because the market's changed, costs of things have changed, inexpenses, like all that stuff changes. But if you don't know that, if you can take a look, I can take a look at any financial statement and go, oh, what's the problem here? That seems off. And I can start to ask questions about stuff. And I got my commercial lender guys also underwriting the deal as a third party saying, hey, look, and then I'll be like, hey, what do you think I missed? That's important to know that stuff. Next, deferred maintenance on the property. What's going on? What's wrong? When was the last time they did the roof, the gutters, painted the buildings, did the parking lots, the stuff internal, all the internal units. What you can see as deferred maintenance is a telltale sign of what's going on, of all the stuff you can't see, right? We did a due diligence on a 177 unit apartment building outside, immaculate. When we started going through the units individually, one by one, at that time, I was still going through every unit. I'll still go through every unit because I like that. I want to see what's happening. Nothing that we found was something that we were told. Every problem we found, we had no idea about going in the door, and all of a sudden the seller was like, "Oh, we didn't know that. Oh, we didn't know that. Oh, we didn't know that." It's our job to find that out. Next, performa. This is the performa. Don't get tripped up. Do not hit the pothole of believing what the performa says. Believe but verify. Trust but verify, like my mentor says. Next, location. Don't downplay location. This I can probably say you can draw a circle or a line around that 40 times. Do it. The location is the most important thing. Do not compromise location. Avoid that pit hole, pothole altogether. Management. Who's going to management? You need to get the right management company. You don't need a bulldog, or you may, right? You need somebody who's going to run hard control and make sure people do what they need to do, but still feel appreciated and service there. Your residents are your customers. Just like for us, when we're looking at a deal, we're looking at our residents as potential customers. How can we make sure they're happy, right? For us and our investors, so that way we can continue to grow. Next, the debt. Can you get the debt? Right now, I think the 10-year treasury is somewhere around 3.8, 3.9, somewhere, and I'm guessing because I didn't look today because it's the weekend. But that's different than what it was 2 years ago when the 10-year treasury was like 1.5 or 1.7. And you start to understand how the debt actually works. So that's a pothole people don't really always get. Good debt, bad debt. Can the property take debt? What kind of debt are you getting? If it's a small deal, then you're not going to get the best debt. You're not going to get the best rates. The bigger the deal, the better the debt. It just always is that way. So next thing, bad debt. That's not bad debt here. This is bad debt on the asset, right? As you go into the P&L, like, hey, concessions, accounts receivable, people not paying, evictions, cost, all this stuff that's owed to the property. Like, what's the bad debt? And this is like a, I hate to say it, but I'm just gonna tell you guys the truth because I look at this stuff and I don't care who hates it. That has everything to do with the demographics. You don't find a lot in better demographics, better locations. You don't find a lot of bad debt looming over great assets. People want to pay. People don't want to have bad debt associated with them from where they live at in these greater assets. When you're investing money, that look at that. Hey, like when we look at a deal and you're looking to invest with like a group like us, like Bell Capital, and you're an investor, you're a passive investor, we're going to be like, hey, man, there's not a lot of bad debt on this thing. There's a couple of little things there. We're going to chase that money down first, give people an opportunity to make it right. But if you don't know this will be a pothole that'll kill your deal, guaranteed. Last but not least, lost deals. If you're looking at a bunch of deals and one falls out, now you need 3 deals to just find that next one deal as a replacement to get an understanding of what you're doing. This is a pothole you need to avoid. You need a lot of deal flow, always. You need a team associated with that. If you're doing it the way we're doing it, you're going to need the top 2 brokers in your market. There's only one, and then there's a second. You want to have more than one flow, and you want to be talking to the groups that own all these properties. Even though you're not going to buy directly from them, you're always going to have a broker on a deal who controls the deal. You do need to be known. You need them to say, "Oh yeah, the acquisition guy at True America or the acquisition guy over at EQR knows who Bell Capital is. They know who Victor is. They've already been in communication." So we had a situation that happened like that with BlackRock. I already had a connection in their acquisition disposition, and then they put me in contact with the broker on a deal that I wouldn't have even known because we already in touch. And then the broker was like, "How'd you guys find out about this?" And then we were able to say, "Hey, we know X over at BlackRock," and that's how we knew. And they were like, "Oh, that opened the door for us, but you can't do that if you aren't counting to not hit that pothole of losing a deal. You better be talking to people. You better have more deals coming in that you can buy." And if you're investing, you want to invest with somebody who that's their my whole organization is built on 2 things. Great investors, making sure our investors are going to be happy with the investments we get, and getting the perfect investment that we know is going to continue to pay us and our investors for decades to come. All right, that's the goal. So I hope this helps you guys. These are what is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Yeah. What? 12. Because I threw some extra up there. That is the 12 potholes you should avoid, or potholes to avoid when you're investing in multifamily real estate. I hope that helps. Something that I do all the time. Man, I wish somebody told me this, because when I got started, man, all I cared about was size and price. None of this other stuff mattered to me until I started learning. I was like, oh, wow, no one taught me this. I needed to be looking out for this. And then when I did learn, It was through getting hammered. So you don't have to go through that. I built Bell Capital so you could just be like, hey, I don't want to learn on this. I don't want to worry about this. I would just rather invest because I like what that guy's saying. I like what they're doing. I like what they're about. They're conservative. And I just want to get castle and I just want to grow my wealth through a group of people that care. All right. So I hope that helps. Push this. I'll push this over here. I hope this helps you guys. Thanks for staying with me on this. And like this video, subscribe to this video on my channel, subscribe to the channel, and share this for people that you know need to see this. Look, if you're looking to invest, you need to be accredited. We would love to have you. We want to talk to you. The thing I hate the most is trying to get information and not having a real live person to talk to. I had to go through that last week where I called the company like 7 times. I do that. We do that. So you guys don't have to do that. So that way, if you're dealing with us, we give you the information and you don't have to deal with waiting to get your questions answered or have to deal with a freaking chat bot when you're looking to invest 100,000, 500,000, $1 million. That's crazy. So, that's why I'm doing what I'm doing, right? That's the number one thing. So people can get their questions answered real time with a real human being about investing money and growing your investments and wealth for you and your family. So yeah, for that, go to bell-capital.com. The link is also in the comments, the comment section and the descriptions, as well as if you need anything, we're here for you. Leave me a message. Love to help you. I want to help you guys change your financial future for you and your family. That is my goal at Bell Capital. I want to send checks every month to everybody, and I want to do this with people I enjoy as my partners, and I want to work for you guys. All right. So have a great day today, and like and share, and make sure to catch up on our next video. See you guys soon.